Two neighbors, same street, same year, nearly identical salaries. One of them will retire at 59 with over $500,000 in invested assets, a paid-off home, and complete freedom over how the rest of their life unfolds. The other will retire at 67, not because they chose to keep working, but because stopping earlier simply is not an option. The math will not allow it. From the outside, the second neighbor looks more successful. Their home is larger, their yard is more impressive, their driveway has always had newer cars in it. Visitors comment on how well they have done. Their home became, over 20 years, the central visual proof that they had made it. But the first neighbor quietly built something the second one never did. Not a bigger house, not a more impressive driveway. Freedom. And the distance between those two retirements, one full of options, one full of obligations, was created almost entirely by a single decision made on a Tuesday afternoon when both of them sat across a desk from a mortgage officer and decided how much house to buy. This video is about that decision. Specifically, it is about why stretching to buy more house than you actually need is the single most effective way to silently dismantle the wealth you are trying to build. Not because houses are bad investments, but because the true cost of a larger home is not the number on the price tag, and most people never calculate what it actually is. Before we get into the numbers, we need to name the belief that makes this mistake so easy to make and so hard to see coming. Most people carry a deeply embedded idea that buying the most house they can afford is responsible financial behavior, that stretching slightly beyond comfortable into the next tier of home is what financially capable adults do. That a bigger home in a better neighborhood is not just a lifestyle choice, it is an investment, an asset that will appreciate and eventually reward the sacrifice. This belief is everywhere. It comes from parents who watched home values climb through their own decades of ownership. It comes from real estate professionals whose commissions scale with the transaction size. It comes from a cultural narrative that treats square footage as a measure of how far someone has come. And it is, at best, dangerously incomplete. At worst, it is the framing that will cost you $1 million you never see disappear. Here's the reality that changes everything. The mortgage payment is not the cost of a home. It is approximately half the cost of a home. The other half, the half that never appears in the glossy listing or the mortgage approval letter, accumulates quietly, month after month, in categories most buyers never think to add up before signing. Let us build the honest picture. Consider the difference between buying a 4-bedroom home in 2014 for $450,000 versus one priced at $480,000. That gap might feel like a stretch that pays off. More space, a better neighborhood, the home you actually wanted rather than the responsible starter option. The mortgage payment difference on those two homes, with a standard down payment and prevailing interest rates, runs roughly $900 to $1,000 monthly. That alone is significant, but it is only the beginning. Property taxes scale with assessed value. On a higher-priced home, the annual tax bill commonly runs $2,000 to $3,000 more than on a modest one. Homeowners insurance increases proportionally with replacement cost. The larger the home, the more it costs to insure, adding $500 to $900 annually. Utilities, heating, cooling, electricity, water, scale with square footage in ways that feel small monthly but add up to $1,500 to $2,500 more per year. And maintenance, the category that catches almost every new homeowner off guard, follows the consistent rule of thumb that 1% to 2% of a home's value should be budgeted for upkeep annually. On a home costing nearly $500,000, that's $5,000 to $10,000 per year, a meaningful portion of which goes to systems, roof, HVAC, plumbing, that are simply larger and more expensive to service than their counterparts in a smaller home. Add those layers together, and the true annual cost difference between a modest home and a stretched one frequently exceeds $12,000 to $15,000 beyond the mortgage payment alone. $12,000 to $15,000 per year that does not go toward retirement accounts, does not go into investment portfolios, does not compound into anything. It simply maintains a property that is larger than the household genuinely needed. And then there's the down payment. A larger home requires more cash at closing. Every additional dollar committed to a down payment is a dollar removed from investments at the exact moment in a person's life when compound growth has the most runway ahead of it. $40,000 in additional down payment invested instead at historical market returns becomes something dramatically larger over 20 years. That opportunity cost is real, even though it is entirely invisible. Let's make this concrete with two real households. Daniel and Rachel bought a 4-bedroom home in 2014 for $450,000. Their combined income was strong, and the mortgage payment felt manageable. They told themselves they were buying for the future, room for the kids, a home office, space to host family. The monthly housing cost came to $2,800, including taxes and insurance. Omar and Sophie bought a 3-bedroom home on the same street the same year for $290,000. Their income was nearly identical to Daniel and Rachel's. Their monthly housing cost came to $1,800. That $1,000 monthly difference doesn't sound catastrophic, but follow it over 10 years and the picture becomes startling. Daniel and Rachel's larger home required more furniture to fill it. The rooms that were supposed to grow into became storage and eventually a guest suite used 4 times a year. The yard was twice the size of their previous home and eventually required a landscaping service. The HVAC system was replaced in year 7 at a cost that genuinely rattled them. The roof at 2 years later rattled them again. Their property taxes increased steadily as assessed values climbed. By 2024, their total housing cost, mortgage, taxes, insurance, utilities, maintenance, averaged over $4,500 monthly. Omar and Sophie's smaller home fit their existing furniture. The yard was manageable. When systems needed replacement, the scale was considerably less punishing. By 2024, their total housing cost averaged $2,600 monthly, and by that point, the mortgage was nearly paid off, dropping their monthly obligation further. Daniel and Rachel today have roughly $160,000 in retirement savings. Omar and Sophie have over $580,000. Same street, same decade, same starting income. The gap between those retirement account balances was not created by luck, by inheritance, or superior investment skill. It was created by the difference in what each household committed to every month in housing costs, and therefore what was left available to build anything else. The financial math is damaging enough on its own, but there's a psychological dimension to the bigger house that multiplies the damage in ways that are harder to see and harder to stop. When you buy a larger home in a premium neighborhood, the home becomes a social context, and that context generates its own spending. The furniture that worked perfectly in the previous home looks small in the new rooms. The yard that is twice the size needs landscaping that matches the neighborhood standard. The driveway of a $400,000 home in an upscale development creates quiet pressure around what sits in it. The holiday gatherings that were previously rotated become anchored at your house because you have the space, which means you absorb the cost. None of these pressures announce themselves at closing. They arrive gradually, one reasonable-seeming decision at a time. New furniture for the oversized living room, a patio for the expanded backyard, a car that does not look out of place in the development, holiday hosting 3 years running because the guest room makes you the obvious choice. Daniel and Rachel spent over $30,000 in the first 3 years furnishing and setting up their larger home beyond what their existing belongings covered. Omar and Sophie spent under $5,000. That $25,000 difference, invested at market returns for 20 years, grows into a number large enough to fund a meaningful portion of retirement. This is the anchoring effect of a bigger home. It does not just cost more directly, it reshapes the entire spending baseline of the household that lives in it and makes every subsequent financial decision more expensive. The most persistent justification for buying the biggest possible home is the investment argument. Real estate appreciates. You are building equity. The house pays you back over time. This argument sounds intuitive and feels reassuring. The numbers behind it are considerably less flattering than the story suggests. Over the long run, residential real estate in the United States has appreciated at an average annual rate of roughly 3 to 4%. The stock market over the same historical periods has returned somewhere between 9 and 11% annually on average. A dollar invested in a broadly diversified index fund has grown to roughly 3 times what a dollar invested in a home has grown to over equivalent multi-decade periods. More importantly, home equity is not liquid. It sits inside the walls of the property, accessible only through selling, refinancing, or taking on additional debt. Investment account balances can be drawn down incrementally as needed. Home equity cannot be spent a little at a time without significant friction and cost. The person who reaches retirement with $400,000 in home equity and $150,000 in retirement savings is in a dramatically worse position than the person with the same net worth distributed the other way around. And when you sell a home to access that equity, you still need somewhere to live. The appreciation in your home has almost certainly been matched by appreciation in alternative housing. Unless you are dramatically downsizing or relocating to a lower-cost area, the equity you have built largely offsets the cost of replacing what you are selling. The net gain is frequently much smaller than the headline number on the sale suggests. The bigger house was never the investment it was described as. It was a consumption decision, one that feels like an investment because the money goes into something tangible and the costs are spread across decades rather than appearing on a single receipt. To make this completely concrete, consider the total 10-year cost differential between Daniel and Rachel's home and Omar and Sophie's. Higher mortgage payment, roughly $1,000 monthly, $120,000 over 10 years. Higher property taxes, averaging $2,000 annually, $20,000 over 10 years. Higher insurance, averaging $700 annually, $7,000 over 10 years. Higher utilities, averaging $2,000 annually, $20,000 over 10 years. Higher maintenance, averaging $4,000 annually above the smaller home, $40,000 over 10 years. Additional down payment committed at closing, approximately $40,000. Total 10-year cost differential, including down payment, approximately $247,000. That's how much more Daniel and Rachel spent not on living better, but on living larger. And because that money was spent rather than invested, it didn't just cost $247,000. It cost the compound growth that $247,000 would have produced over the years that followed. At historical market returns, that opportunity cost adds another $150,000 to $200,000 to the true price of the bigger house over a 30-year timeline. The bigger house didn't cost $200,000 more than the smaller one. It cost closer to $400,000 more when the full picture is calculated honestly. That's the number that never appears in the mortgage approval letter. If you are currently renting and approaching a first purchase, the most valuable reframe is this. The bank's approval amount is not a recommendation. It's a ceiling calculated to serve the bank's interests, not yours. A meaningful rule is to target a home priced at 60 to 70% of what you qualify for, so that the remaining capacity flows toward investment accounts rather than housing. If you are currently a homeowner who recognizes this pattern in your own situation, the most important move is resisting lifestyle inflation pressure going forward. Prioritize retirement contributions above home improvement projects. Make the decision about every home upgrade based on genuine need rather than neighborhood comparison. And if the home is significantly larger than the household actually uses, run the honest math on downsizing. The equity released and the monthly cost reduction can materially change the retirement trajectory even mid-journey. If you're approaching the housing decision in the next year or two, run the complete cost calculation before the emotional pull of a property takes over. Add up mortgage, taxes, insurance, utilities, and maintenance for each option you are considering. Multiply the annual difference by 25. That number is what the larger option actually costs over the long term, not just the price differential. Make the decision with that number visible, not hidden. Omar and Sophie's home doesn't photograph as impressively as Daniel and Rachel's. Nobody pulls into their driveway and comments on how far they've come. The investment account growing in the background of their financial life is invisible to everyone who visits. It doesn't generate compliments. It doesn't create the quiet pride that comes from owning a home that signals success to everyone who sees it. But when Omar turns 58 and sits down to calculate whether he and Sophie can stop working, the answer is yes. Not maybe, not if everything goes right. Yes. That answer was not purchased with a bigger income or a better investment strategy or a lucky stock pick. It was purchased with a smaller house and a clear understanding of what the difference in monthly cost would build over 2 decades. The bigger house will always feel like progress. It will always feel like the responsible choice for a family on the way up. It will always generate more admiration from the people around you than the modest home will. But at 60, standing at the edge of the rest of your life, the only question that matters is whether you have the freedom to live it on your own terms. That question was answered, for better or worse, the day the mortgage was signed. Choose the house that serves the life, not the one that consumes it. If this reframed how you think about housing and wealth, share it with someone who is about to make this decision. And if you want to keep going deeper into the financial choices that quietly determine how everything turns out, stick around. That's exactly what this channel is built for.